Hello guys, welcome to another video. Today we are going to talk about accounting for investments. So first we need to know what is the investment. Investment mean to say when we will buy the debt securities or equity securities of other company, that is called your investment. So here we are going to talk about accounting for investment in equity securities. So first you should remember overall what are the equity securities. Equity security is an ownership interest, okay, in an entity, example common stock or preferred stock, or a right to acquire or dispose of such an interest. It might include warrants or call option. But when it comes to the accounting, you should remember here, because we want to learn accounting for equity securities, okay, our investment in equity securities. So here you can just simply assume when we buy the common stock of other company. Common stock means say when you buy the voting stocks of other company. So how we can do the accounting for that. So you should remember here, because we need first classification to do the accounting. So this is here we have a percentage of ownership. Okay, percentage of ownership mean to say how much percentage of voting rights you have. Okay, here we have presumed influence column. Presumed influence mean to say do we have influence over investee or not. And third, here we have a accounting method, like which method we will use for accounting. So you should remember here guys, if your percentage of interest is between 0 to 20%, it means you have a little or none influence over the investee. And here which accounting method we will use to do the accounting, we will use fair value measurement. Okay, second scenario is what if your voting rights are between 20% and 50%. You could have any percentage, maybe 30, 40. So it means you have a significant influence over the investee. So significant influence means to say you have a power to participate in operating our financial policies of the investee. And here, as per US GAAP, you can use either equity method for investment or you can use fair value option. Okay, it is similar to fair value measurement. We will see in future what are the differences. Okay, so but here you have an option. So but if your percentage of voting right is more than 50% till 100%, so it means you have a control over the investee. So here what is required, consolidation is required. What is consolidation, we will see in the future classes, in the future video. So here what we are going to talk about today, we are going to cover this portion. What if your percentage of voting interest is between 0 to 20%, and we are going to talk about how fair value measurement you will use to account for this investment. So here we go. So you should remember here, guys, if you want to measure the investment, okay, in equity security, so you should ask first two questions. You should check these 2 points. Point number one is what if market value is readily available, like of those stock in which you have invested, is the active market price is available? If yes, so which model we will use? We will use fair value model. But if the market value is not readily available, maybe those are the stocks of the small company whose stocks price is not available. So here we can use measurement alternative. Okay, we will see what it is. And don't forget, this measurement alternative is not allowed under IFRS. Okay, you should remember it is not allowed. Okay, so but in US GAAP it is allowed. So we will see how it can work. So here we go. We are going to start with the fair value model. So you should remember here, fair value model, we have a few theoretical point. First of all, in balance sheet, what you will do, you will record your investment at fair value. Okay, fair value mean to say what is the market price at that date. Okay, so then you should remember, whatever the unrealized holding gains or losses, whatever you will have, For example, if you have purchased the stock for $10, maybe at the reporting date market value is $12, so you have a gain. Because still stocks are with you, it is unrealized gain, so you could have a loss also. Don't forget, all the gain or losses we will record in the income statement, I mean to say earnings, okay, in the income statement, okay. And now you should also remember, when you invest in the stocks, you will also receive the dividend. So this dividend we will also record into the income statement, okay. So this you should remember all these points. Now what to do in the cash flow statement, as we will go, I will talk about here. So the presentation of the cash flow statement actually, it depends on the nature of investment and the purpose for which you have invested. So it depends, you will record in operating, investing activities, it depends, and we will see, okay. So these are three common rules which you should remember. So first I'm going to just cover the double entries. What entries orally we will discuss, then we will practice the question. For example, the first entry you should remember here, when you will buy the stock of other company, and don't forget your percentage of voting rights is in between 0 to 20%, okay. So at the date of purchase, what entry you will pass, you will make debit investment in X company, whatever. So you can say debit investment, it is like your asset, okay, and credit will go to cash account, okay. This is the entry at the date of purchase. Then what you will do at the reporting date, you could have gain or losses. So second entry we are going to talk about for unrealized gains or losses due to changes in the fair value, because maybe you have purchased for $10, now stock price is $15, so you have a gain. So if there is a gain, unrealized gain, what entry you will pass, you will pass debit investment account, okay. And credit will go to unrealized gain, and don't forget, this gain will be recorded in the income statement. So you could also have a loss. If you have a loss, what entry you will pass, debit unrealized loss, which you will record in the income statement. And credit we will take it to the investment, because due to loss your investment value should be reduced, okay. So then we have a third overall entry, which is entry for the dividend, because once you will receive the dividend, I'm assuming it is not a liquidating dividend, it is a normal dividend. So what entry you will pass at the time of receipt or at the time of right to receive, so you will make debit cash or dividend receivable in case if it is not yet received. And credit will go to what, dividend income. And don't forget, this dividend income you will also write in the income statement. Now we have here fourth entry. You should remember here. So maybe at some point in time you might sell the investment. If you are going to sell the investment, so what entry you will pass at the date of sale, and you will make a debit cash, okay, with the money whatever you have received. So credit will go to investment, okay, whatever value which was showing in the balance sheet, because you have to remove the investment, okay. And now you might have a difference on debit side, okay, or on credit side. If you have a difference on debit side, we can say it is a realized loss, okay. If the difference is on credit side, we will say it is a realized gain, okay. So this is what the entry you will pass when you will sell the investment. Now here we go, let's have a look, let's practice through the help of example to understand in better way. So you should not forget, this is a summary. In balance sheet, what I told you, we will record our investment at current market value. This you can directly calculate this way also to solve the question. You can take number of stocks times market value per stock, okay. And in the income statement, so all the gains and losses, realized, unrealized, okay, if you have, you will put into the income statement, and these gains or losses will arise due to changes in the fair value. And plus in the income statement you will also record the dividend income, okay. I'm assuming it is not liquidating dividend, okay, because liquidating dividend you will not take it to the income statement. We will see in the future classes. So here just you should remember. Then guys, Uh, Question number, we have a one here. For example, on November 1, year 1, A company purchased 200 shares of G company, okay, common stocks at fair value. So we will see what is the fair value at that day. So this investment is less than 1%. Oh, it means so you don't have any influence. You have to use fair value model of the ownership interest in Galley company. Then they're telling you the following are the fair values per share of Gale company stocks at relevant date. So this is what is at the date of purchase. This is your date of purchase, November 1. So the stock price was 100. So, and then you have a 31st December year 1. I'm assuming this is the first year end. Your stock price is 90. And at 31st December year 2, your stock price is $115. So what entry you will pass here? Guys, first of all, you need to pass the entry at the date of purchase, which is November 1. So what entry you will pass? You will make debit investment in equity, and credit will go to cash. With which value? Because you have purchased 200 stocks times 100 was the market value at that day. So you can look at here. Okay. So it means you will make debit investment in equity securities with 20,000, and credit will go to cash by 20,000. Okay. Now here at the balance sheet date, please don't forget, because at balance sheet date your market value is $90. So you can look at here, you purchase for 100 but market value is 90, so you have a loss of $10. This is unrealized loss. So if you want to calculate total loss, you will multiply with the number of shares, which are 200 shares. So you will get total loss. Total loss will be 2000. And for the loss, you will pass this entry. Debit will go to unrealized holding loss. You will write in the income statement with this 2000, and credit will go to investment in equity security with this 2000. Okay, so now maybe you are thinking what you will do in the balance sheet. So in simply, as I told you, in balance sheet your investment will be recorded at market value. In year 1 I'm talking about, this is year 1 information. So in balance sheet, you will record investment at market value. Okay, so market value is $90, and you have a number of stocks are 200. So it means if you will multiply, I guess you will get 18,000. This will be the presentation in of the balance sheet in year 1. Okay. Now what you will do in the income statement, of course, in income statement you will write the loss, okay, of 2000 which you have calculated. Here we go. Then what happened in year 2? Actually, if you look at here in year 2, our value is $115, and in the last year balance sheet the value was 19. So you can look at here now, there is a gain of $25 per stock. If you want to calculate total gain, so multiply with the 200 stocks. Okay, you will get total gain of, I guess, 5,000. Now what you will do with this 5,000? You will pass the entry. This is the entry you will pass. Debit investment in equity security by 5,000, and credit will go to unrealized holding gain by 5,000. Okay. So then in the year 2, in balance sheet, what you need to do here in year 2 I'm talking about, of course, this is year 2. In balance sheet you will record your investment in asset section, how much at current market value, and market value is 115 time number of stocks are 200. This will be the value in balance sheet. And in income statement you will take this loss of 5,000. This loss you will record as a, sorry, it's a gain, not a loss. Here we have a gain. Okay, so you have a gain of 5,000. Okay, you will record in the income statement. Now, because there is no information about the sale, but as I told you, if there is a sale, at the time of sale you will do debit cash. Okay, with the value whichever you will receive, credit investment with the value whatever is showing in the recent balance sheet, and check the difference. If difference is on debit side, it is a loss. If difference is on credit side, it is a gain, and these gain or loss you will take it to the income statement. Okay, now here we have another method, a measurement alternative method. Please focus, it's a little bit subjective. As I told you, this measurement alternator method, first you need to remember when to apply. So we can apply this measurement alternator method for those securities which without a readily determinable fair value, like whose stocks or whose market values are not available. So then you can use measurement alternative. And as I told you, this is not allowed in IFRS. Okay, it is allowed only under US GAAP. Now maybe you are thinking, oh, what is the measurement alternative? So how you will record your inventory in balance sheet, inventory, I mean to say investments in balance sheet. You will take measurement alternative. This is how you will record. You will take cost of investment, okay, whatever you have paid, minus impairment if any, or plus minus any changes resulting from observable price changes. So in short, this is the format. So you will take in balance sheet, you will put the cost of investment, whatever value is there, okay, less impairment, okay, if any, you will subtract that value, and plus minus any changes, plus minus any changes, observable changes in price, okay, plus or minus. This is how you will get the carrying value of investment. Okay, now here maybe you are thinking cost, from where you will get this cost. Sorry, maybe my screen is creating a little bit issue. Cost, of course, you will take when you acquire this investment, how much you have paid, that is called cost. And as per GAAP, generally we don't include that transaction cost. Now the question is that how to calculate this impairment. I'm talking about impairment. So impairment is really important here. You should remember here because it is a little bit subjective also. If you want to calculate the impairment, so first you should check if the fair value of investment is lower than its carrying value. Mean to say, fair value, if it is less than the carrying value, I mean say your carrying value is more than the fair value, it means your investment has impairment. Okay, now maybe you are thinking of from where to get these fair value. Okay, because fair values are not readily available, that is why we are using a measurement alternative method. So then from where you will get the impairment, so I will explain, don't you worry. First of all, if you know your carrying value is greater than fair value, so there is the impairment loss. And this impairment loss, how you will calculate, you will take the carrying amount which is showing in the balance sheet minus its fair value. The difference is called impairment loss, and this impairment loss you will subtract in the format, okay, when you calculate the carrying value here. Okay, here we subtracted the impairment loss. You got my point? Then here, how can we calculate the fair value, because fair values are not readily available. So here US GAAP says you need to estimate this fair value. Okay, now how we can estimate? So we can use three approaches. The first approach, which is called market approach, okay, second approach we can use income approach, okay, and the third approach we can use cost approach. Okay, what is market approach? Please here, because I can't explain the calculation of these things like income approach especially, because we will study, but here this is the estimates. Market approach mean to say it is based on information such as multiples of prices from market transaction, okay, involving identical or comparable items. For example, if you are buying the stocks of, if you want to determine the fair value of stocks of company A, maybe there is a company B which is similar or comparable with the company A. So maybe you can use their prices, company B's prices, to determine the stock price of company A. This is what is called market approach. Second approach, which is called income approach. Actually here what you need to do, you will always calculate the present value of future cash flows, which is also called discounted cash flows techniques. Huh? So, but this second income approach, which is also called discounted cash flows techniques. So, because I can't explain it here how you will calculate it, but I can just give you idea. you will calculate the present value of future cash flows usually, which is the dividend. So if you will calculate the present value of the dividend, so you might get the fair value of the stock. And the third is what is the cost approach. Cost approach is based on current replacement cost. It is the cost to buy or build a comparable assets. Like if you will buy it today, what is the market price? Okay, so that is called cost approach. So you can estimate by the way, okay, but standard says you don't put unnecessary efforts, but check if there is any impairment. This is what is called measurement alternator. Okay, so that is it, guys. So I hope it is clear. Because measurement alternative is not an option under IFRS. So let me just show you the difference of IFRS also. Here we have IFRS difference. Please don't forget. As per IFRS, they are telling you an investment in equity securities that does not result in significant influence or control over the investee is measured at fair value through profit and loss account. Okay, like if you don't have any significant influence, so you will use the same approach as just we learned in US GAAP. However, investor also may irrevocably elect the initial recognition of to measure the investment in equity securities that is not held for trading. Like in short, if your investment is not classified as held for trading, so investors can also select the accounting policy. They can record the fair investment at fair values through the OCI. Like as we have taken the changes in gain fair values, we have taken to the income statement. There under IFRS, if securities are not trading, classified as trading securities, so you can also elect the changes in fair value you can record in the OCI. This is the second policy. Then they're telling you holding gain or losses accumulated in OCI are never classified to profit and loss even when the investment is sold. So reclassification is not allowed. Okay. So here we have where a simple idea. Second is what if measurement alternative, as I told you, it is not the option under IFRS. Okay, under IFRS, an investment in equity security that does not result in a significant influence or in control over the investee is measured at fair value. Okay, so then here we have a small presentation of IFRS. If you are IFRS student, so you should ask these questions from yourself. So the question number one is, you need to ask yourself, does your investment does your investment in equity securities result in control or significant influence? Okay, like do you have control or significant influence? If yes, of course, in case of control, its consolidation will be applicable. In case of significant influence, equity method you will use only. You don't have any fair value option model if you have significant influence under IFRS. Okay, if you don't have a control or significant influence, then you have to check another point: is the investment held for trading purpose? If no, so then the investment should be measured at fair value through profit and loss. Like the gain or losses, you will take it to the profit and loss. If the investment is held for trading, if answer is no, was the fair value option through OCI selected at initial recognition? Because here you have an option. You can take gain or losses to OCI, which will never be reclassified. If yes, you have selected the fair value option through OCI, so then the investment is measured at fair value through OCI. Holding gain and losses are never reclassified from OCI. So this is what you do under IFRS if you are IFRS student. So in the next video, we will talk about how to deal with the equity method. Thank you so much, guys. See you in the next video. Bye bye.